Welcome to the new edition of the Analyst Corner. I'm Nirmala Balakrishnan, your host for today. My guest today is Mr. Stanton Jones, Distinguished Analyst from ISG. Stanton leads ISG's index research, helping service providers, institutional investors, and enterprise technology leaders make sense of the global IT and business services sector. Thank you, Stanton, for taking time out to talk to nasscom, and welcome to this call.
Thanks, Nirmala. Great to see you.
So I will quickly start with the question which deals with the ISG index that was published this quarter. So can you share some of the key takeaways from the index, related to some of the top deals that have made an impact and driven growth, specifically across segments like IT, BPO, SaaS, and also are there any standouts in terms of deal strategies, large versus small projects, discretionary versus non-discretionary, cost optimization? So can you throw some light on these the deals?
Sure, happy to. So I think really the kind of key takeaway from the call that we did for our second quarter call is, if you think about managed services, really had its best quarter in the history of the sector. Over 10 billion of annual contract value was generated. And that's the first time ever that the sector has passed 10 billion of ACV. And if you kind of dig down to where that growth is coming from, it's really coming from applications development and maintenance. That was up almost 20% year over year. And that's really a pretty significant growth number when you consider the fact that ADM is now over 65% of all the ITO ACV in the market. On the flip side, while managed services really had a banner quarter, cloud continues to be under a lot of pressure due to the macroeconomic environment. So if you look at infrastructure as a service on a bookings basis, that was down 20% year to date. And that was only the second time ever that infrastructure as a service bookings have been negative on the half year. And if you look at software as a service, it was also down 6% year over year. We're continuing to see a lot of pressure on deal sizes and sales cycles continuing to lengthen. So on your question around deal activity, back to the managed services side, there was a huge amount of contracting activity in the managed services sector this quarter, over 700 managed services awards. That was the second most ever. If you look on the ITO side, some notable deals. There was a large ADM agreement between Infosys and BP, a 5-year workplace services agreement between Cognizant and Nike, and there was a large SAP agreement between IBM and Diageo. And you also asked about BPO. On the BPO side, not a specific deal per se, but did want to call out kind of an interesting trend that we're tracking. And that's that we had 2 new customer experience providers join our leaderboard this quarter, Atento and T-Tech. And that's really a reflection of the strong growth that we're seeing in the contact center space. And then finally, on the deal and award size angle, did want to mention that we had a large number of mega awards this quarter. And in ISG terms, that's an award of 100 million of ACV or greater. So we had 10 mega awards this quarter. Most of those were in Europe. So we've actually had 18 mega awards through the first half, which is the most the sector's seen since 2014.
Great. And since you mentioned most of the managed services ACV growth this quarter came from the EMEA region. So can you share some insights on this new trend that we are witnessing in terms of, Europe emerging as a key growth driver? And do you think this will continue in the second half of the year and can be a key growth driver for this year?
Sure, you're right. Europe was very strong this quarter. It was actually a record-breaking quarter for the region. It generated over 4.5 billion of ACV, and that was for the first time ever. Most of that growth came from the UK, which was up 50% year over year, and DACH, which was up 16% year over year. It's also important to note that a lot of that growth came from the mega awards that I just mentioned. 5 of those mega of the 8 were in the EMEA region. That said, to your question about driving growth, we do continue to expect that EMEA is going to drive a lot of the growth for the overall global sector for the balance of the year. But it's important to keep in mind that the third quarter is typically kind of soft, primarily because of the holiday season in Europe.
If you look at this quarter results, global IT quarter results that came out, can you share some takeaways from the results and for the big players? What is driving strong demand for outsourcing? And also, have you witnessed any new buying patterns that are emerging, which providers need to be cognizant about?
Sure. So I think if you look back about what was reported, I think I'd probably characterize it as cautious optimism would maybe be the best way to describe it. On the caution side, the macroeconomic picture, as we all know, is still very unclear, lots of mixed messages. That's resulting in a lot of pressure on discretionary spending, but at the same time, it's also creating a lot of opportunity on cost optimization, which is really what's driving a lot of that managed services record-setting managed services growth. You do see a lot of focus last quarter on providers growing margins. So you can see this reflected in how providers are starting to slow down hiring and really focused on optimizing delivery pyramids. They're doing more work offshore, increasing utilization, which actually ticked up again this quarter. On the optimism side, there's obviously significant opportunity around generative AI and AI in general. In my view, this is sort of like the early days of cloud. Every large firm across the globe is looking to develop an AI strategy, not just a generative AI strategy, but an AI strategy in general, and an operating model to actually get value and push products out around AI. That obviously creates a tremendous amount of opportunity for service providers. That said, it's also going to put a lot of pressure on service providers to deliver more faster. So, in our view, providers that can integrate this technology, whether it's generative AI or AI in general, into their own delivery in order to make them better, faster, and cheaper, we think are going to be well positioned.
Yeah, agree with you. AI is the current buzzword, and all all the firms are looking at how to invest in that or make use of that. Now, moving into, you also spoke about the hiring and talent scenario. We saw the last few quarters witness a steady decline in attrition, but also at the same time, hiring has stabilized compared to the previous 2 years. So, any insight on the hiring and attrition trends that the industry should watch out for? Any skills? I know AI is something that, in terms of skills, also companies would be looking out for. So, anything that you can share?
Sure. Yeah, it's been a super interesting time on the supply side of the equation. I think it's always important to remember that the IT services sector is all about supply. It's about smart people that can help companies implement and extend technology. It's unlike any other part of the overall tech sector. So, our supply is people. And I think that's a really, really important part of the equation. That supply side has seen really unprecedented level of change over the past 36 months with huge amounts of hiring, but also really elevated levels of attrition. That's been changing over the past few quarters. Hiring has been slowing down in reflection or in response to the macroeconomic environment, and attrition has also been coming back down. But what's really interesting, and I actually flagged this last week in my newsletter, is that we did see annualized attrition tick back up in the second quarter to 14.5%. And that was the first time it increased since the second quarter of last year. So I think that's important when you think about that, not necessarily about a short-term uptick in attrition, but when you combine that with the slowdown in hiring, that's something that hasn't happened in a really long time. And so what that means, if you look broadly across the sector, that means that for every 10 people that left their company, only 6 were hired in the second quarter. So ultimately, what we're telling our enterprise clients here, there's nothing to panic about. The supply side is just kind of coming back to equilibrium. But in our view, what it does mean is that there's not a lot of excess capacity in the system. Okay. So when you think about enterprises kicking off new work, especially things like transition, and as you mentioned, looking for specialized skills, it's just really tough to find those specialized skills in the sector right now because of that lack of sort of excess capacity in the system. That said, we do think that that's going to ease up a bit in the second half, given what we're forecasting for growth for the sector for the balance of the year.
Yeah, and we also hear companies, looking at reskilling, upskilling, so that goes on as always. Absolutely. As a strategy.
Huge amounts of upskilling and reskilling happening, lots of investment being made across organizations in order to upskill and reskill existing resources in order to take advantage of a lot of these new technologies. Absolutely agree.
Sure, sure. Now you talked also about the macro environment. So we see that it's still uncertain, and how is this going to impact the IT and business services spending in 2023? And any predictions that ISG is betting on related to also the overall annual outlook, or also for the next quarter in the tech sector? How do you see the next
Sure.
quarter looking like?
Yeah, it's a great question. It continues to be a very, very mixed environment. Probably I've been in the sector and covering the sector for a very long time, and I would say this is the most amount of mixed signals that we've ever seen in the sector. There's
Right.
lots of growth and lots of opportunity, but also lots of pressure around things like inflation and interest rates. And so what that essentially is doing is just creating a lot of uncertainty in the environment. And broadly, when uncertainty happens, companies start to focus more on cost optimization. They focused more on margin protection. I mean, you can see this actually even happening in our sector as well. That said, we have not changed our managed services forecast for the balance of the year. We're sticking with 5%. We haven't changed that since we announced that in January of this year. Obviously, there are patches in the sector that continue to be under pressure. For example, we talked about the banking sector in the second quarter in the Americas specifically was down double digits in the second quarter. That put a lot of pressure on the banking sector, which makes up more than 30% of all the ACV in the IT services sector. That said, we feel like that's going to recover. Some other sector, for example, like consumer goods, is doing quite well right now. So again, a bit of a mixed message. That said, we have not changed our forecast. We're still sticking with our 5% growth forecast, which for this sector is actually quite strong. And we feel like the macro situation is going to continue to get a little bit clearer. But at the same time, really what's going to drive that growth is this continued focus on cost optimization. We see strong pipelines at ISG. We see strong pipelines at service providers. That's why we continue to stick with that 5% growth forecast on managed services. That said, on cloud, we did pull our forecast down again to 11.5%. And that's purely based on, again, the unclear macro environment. There's a couple of different reasons here. Ultimately, if you look at what's happening on the infrastructure as a service side, there was a huge amount of post-pandemic infrastructure as a service buying, lots of announcements around strategic partnerships. Does not mean that enterprises are not still fully committed to cloud being their ultimate delivery model for their enterprise applications. It just means they're really focused on using what they already bought, and that's what's slowing that bookings growth down. And it's important to mention here, we are talking about bookings growth, not revenue growth. Right. And on the software as a service side, that's a really due to, as we talked about, this pressure on discretionary spending. See a lot of focus on continuing to roll out SaaS applications, just making them smaller, shorter. It is lengthening sales cycles, as we talked about, but we do see that macro situation continuing to put pressure on cloud, and that's the reason we lowered our forecast to 11.5%.
So in general, you say it remains soft, but not a very negative kind of forecast that you would say, right? Still...
Yeah, I would say it really kind of depends on the, because of the changes in buyer behavior, because of the strong demand for... Nature. You're right. A strong demand for cost optimization. Our view would be managed services continues to be strong. The demand for managed services continues to be strong. Demand for cloud, I would agree, is soft given the what we talked about on the macroeconomic side.
Yeah. Great. So any parting words? That was my last question. So any parting words that you would want to say about the industry? How optimistic are you about it? I know you spoke about how the whole technology sector is seeing a lot of investments, and it's like a year, you can call it as a disruptive year with so much of AI and all sorts of things. So what would you like to say in the end?
Yeah, I think ultimately we are very much net positive on the impact of AI to the sector. I know there are a lot of discussions happening about potential the potential negative impact that AI could have on the sector. But I think, in our view, this sector will almost always be a supply constrained sector, right? You need smart people in order to implement and extend and scale and manage technology, which is changing faster than ever, right? This is not the model of 20 years ago whereby an organization would implement a large ERP system, get it to a steady state, and then not change it or not upgrade it for 10 years. That world hasn't existed for a decade, frankly.
Yeah.
The pace at which technology is changing, especially related to cloud and AI, cybersecurity, all these really important emerging areas, is only accelerating. So that means organizations need more help than ever to, as I said, identify, implement, manage, extend, and scale and secure this technology. And so ultimately, we do think it's going to have some near term, and when I say near term, over the next several quarters, maybe even the next couple of years, pretty disruptive impact on the sector, meaning the impact on productivity, for example, of service providers. There's going to be a huge amount of expectations from enterprises that service providers are using this technology themselves in order to make their clients better, faster. So there is going to be a lot of disruption there, a lot of pricing pressure, a lot of pressure on skills, but ultimately, we believe that demand is going to continue to remain very strong. We're in the middle of a very long-term secular trend about technology transformation and modernization, and that's the reason, we continue to be of the view that there will continue to be very strong demand for IT services.
That's really great news for all our member companies also. Thank you, Stanton, so much for sharing your insights with us. With that, we come to the end of this session. To share your feedback with us, don't forget to share, comment, and subscribe to our YouTube channel and community portal for more such insightful sessions. Thank you and take care.
Thanks.